Hi, folks. Nick Shaheen here, recapping week ending 9/18 Fed week, the Fed event that came and went. Week ended on a sour note. More on that in a little bit. The weekly candles, you can see here, I've got the the S&P right here. Red candle, disappointing candle, left a big tail on top. Similarly, disappointing candle in the NASDAQ. Those are the Qs, also red. Also, shape-wise disappointing candle in the small caps as well. Left a big tail on top, but ended up closing around here. However, a slightly green candle there. It's splitting hairs. It was a disappointing week. Given why? Because the bulls got what they wanted. Equity bulls got a no hike in September, and a no change in the statement as to what she's watching, and more importantly, they got the fact that Yellen is, the Fed is looking at these global. The reason why they didn't raise was the global events. So the way they worded it, if there were no global events, China and other things that are in the news, then she would not have held back. She would have raised. That's the way I read it, because everything else in the U.S. was okay, and that wasn't okay. It was influenced by outside factors. So that tells me that, first of all, I think it was a chicken move. And I think that given that she showed me that she can be chicken here, she's going to be chicken again and again and again. And I was saying definite raise in 2015. One of my assumptions was based on the U.S., but now that she's looking outside, then maybe not even quarter one of 2016. But anyway, the bulls got what they wanted. They failed to rally. We did have a two-day rally going into the event and a spike into the event up to 2020 or so in the SPX, and then a very disappointing end of the day and a very more disappointing following day on Friday. All right, so the Friday details are not that important, but it's just that if you want to see them in pictures, we had a disappointment as far as performance, except for Apple. Apple held the line. It held all week. It was not rallying. Reasons why the sell-off include many. I just say that there's a lack of catalyst to buy. What are the bulls going to buy? There's no hopium. In the lack of hopium, the buy the dips are gone, and the bounces don't last as long unless they come with a change in fundamentals. Going into the event, we said last week, don't chase it on the pop if just because there was no hike, because it's a relief pop that there was no hike. And indeed, we had 2 days of rallies that sold off, and we're back to like nothing happened. Okay, that's 10 days almost. Well, 5 of the 10 days, but you can see that like nothing happened, right? We tried 2011. This is the ES, so 2020 or so in the SPX. All right, so going forward, we're back to having support and resistance. I think we can see it here. Now, based on the open interest that I see, we have support below and resistance above. But the support below becomes very suspect with all these shoes that are looming above our heads. I mentioned a few, the Greek elections as early as the 20th, just a couple of days. Outcome is still unknown. We've got China economic reports. If they come out bad, oh my gosh, what's going to happen, etc. We have the debt ceiling looming too. Any of these shoes can be triggers for way deeper dips. This was the recent flash crash. We've had recent, anyway, there are sob stories to tell there. If we have one or more trigger, and let alone at the same time, then the downside could be substantial. So I'm not calling for the downside. I want you to be prepared in case it happens, because it is a real technical possibility based on the technicals alone, even if I live inside a cube. And also, fundamentally, we could have scares, triggers from sentiments and headlines that are scary. So I want my portfolio to be ready. You better make sure yours is ready as well. I'm not calling for it. I'm not taking heavy trades based on it to make money on the drop. I guard against it, and I trade along with that idea. You know how to do it. All right, so this is going forward. Focus point, Apple already said. Small caps, they are a little quieter. They have been, and maybe because they represent the market better than the ones. We had big moves in mega caps in the last few weeks, and the small caps are immune to the mega caps, so they more represent the market, so to speak, movement. China, we talked about that. The ranges have held this week and last week based on the open interest. That's pretty encouraging. The SPX has some pretty deep dips on paper that are possible. Same with the NASDAQ, same with the IWM, the small caps. So be careful. And just there's a possibility that big money wants to, book some profits going into the quarter, and they might want to do it while profiting. So if they they can move markets, so be careful. Don't get swept. Avoid weekly trades. If you're trying to profit via credit spreads on the weeklies, I do not play the current week. If a problem happens, that spread goes to maximum loss in an instant. There's no way of saving it. Be careful. VIX is still very elevated. Even though it went up and down this week, it was expiration week for it, but it's still very elevated. This is, we're looking at 1 year. That's the October correction. It's still right here, and these are other mini drops. It's still very elevated. So that is causing a whole ruckus of a whole range of problems, least of which is the fact that if someone needs to buy insurance, they're having to pay up for it. So the VIX is elevated, buying insurance gets expensive. It just tells us that the market, there's still uncertainty in the markets. Bonds rallied again, just when people declare them dead. Here they are, boom, bouncing again in breakout mode. This is I drew this line almost a year ago, and look at that. That was the October correction, and I'll show you conversely. So, but it has failed. So there's still a chance that this is another line I want to see it break out before I call it going to the moon. Rates took a tumble, obviously, yesterday on the gap down, but now back to this, which is also I drew a long time ago, and it's still another pivot, 21.5, back to it. Oil, oh my gosh, terrible day, down 4% on the day. So now almost back into the wedge from which it broke out. But I said, don't chase it. We got to see here. U.S. Fed, we talked about that. Currencies, they're in full swing. We don't know exactly how they're going to affect the whole picture, so be careful. And tickers, I have a few tickers to talk about. I want to bring your attention to actually that was the redness and that we suffered on Friday. Market suffered on Friday. But the reason I brought it here because I want you to see the financials. Last 2 days they have been shellacked. And Goldman, for example, let's see, Goldman Sachs. Early in the day it was a pretty nasty day, down 3% almost. I tell you it needs to hold this line, okay, or a lot lower prices. So I may take a flyer on some puts. Maybe that's an idea. Again, small money because it held the line on Friday, but it was a little weak. So if the markets are weak in general come next week and it loses that line, it's a loosely interpreted, it's a bad price action. Okay, I'm not a technician. I don't troll the technicals to find trades, but this is just one thing I was looking at. IBB relatively holding okay. Gold is up. I called it a good buy last week. So things are moving. And be careful and be cautious. Don't chase up or down. There's no commitment from the bulls, that's for sure, and the bears are not even on the playing field yet, which is scary for the bulls. Nick signing out.